Hello, Dan Passarelli here. How are you feeling today? Welcome to today's webinar. We've got a really good workshop here planned for you. We're going to talk about smart risk tactics for option traders. That's you. That's me too. I want to make sure you can hear me. Would you please go to the Q&A box and give me a big old yes if you can hear me. Hey, Justin's back this week. Welcome. Glad to see you again, my friend. Kostas, good to see you. Mike, Jeff, Michael, you guys are awesome. I love this. Eduardo, all right. Got everybody here. Mr. Anonymous, Mr. Secret Agent Man, all right. Well, let's take a little look-see here. Before we get started, you're having trouble with the picture? Yeah, I don't know. I don't know what to tell you. I think the picture's coming in pretty clear. Looks like it is, right? I don't think anybody else is having trouble, are you? Okay, sounds good, Jen. Okay, my friend. All right. Well, before we get started, I need to point out that options are not for everyone. Read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. Don't trade with money you're not prepared to lose. And everything we're doing here is providing generalized information, not specific to your needs, right? Okay. Now, for those of you, there's some familiar faces here this week, but there's some new friends here. So for those of you who aren't familiar with me, where the heck you been all my life, huh? I'm Dan Passarelli, and allow myself to introduce myself. I am an author of two of the most popular option trading books. Trading Option Greeks is the one that I'm most known for. That one has been rated in the top 5 options trading books by a whole bunch of sources. And then there's the Market Taker's Edge. And I also write a gazillion articles and do a gazillion videos and webinars and in-person stuff. Oh my gosh, I'll tell you, I am all over the place. If you've got an in-person option trading group, let me know. And, or even an online option trading group, let me know. But anyway, I am a trader. I traded for years down on the floor of the Chicago Board Options Exchange. John is back. All right, John, we're glad to see you again. Traded for years down on the floor of the Chicago Board Options Exchange. And traded off the floor. And I trade now every single darn day in a retail trading account, just like you. And I am the founder of Market Taker Mentoring, which is the global leader in option trader education. And I am a trading industry collaborator. I work with a lot of great trading related, options trading related organizations. I work with all of the top options brokers, like Firstrade, for example, and even basically all of the options exchanges globally, as a matter of fact, and media organizations, the whole shebangs. And I'm a family man. Those of you who are market taker students, you know Kathleen. Kathleen helps you out all the time. She's runs operations here. She's like the boss over here. She does a great job in helping you out. And I've got my 2 adult children as well. And I do other things for fun besides trading. I am a runner. Just went out for a run this morning. And I am a foodie. which is why I have to run. And traveler, been all over the world, as well as a musician and just music person in general. And I'm a nerd about a whole bunch of things. History, I read a lot of stuff. Now, I want you to be the best trader you can be. Does that sound like a pretty darn good plan? Would you like to be the best trader that you can possibly be? Yeah, I bet you do, don't you? Well, I want to help you with that. If you go to markettaker.com, so market like stock market, taker like take what is rightfully yours, two T's in a row, markettaker.com, and go all the way over here to join free, then you can get some other free classes just like this one. It'll bring you to our fast tracks and you can join our newsletter. You can request access to our chat room. We'll probably give it to you. We've got member discount. There's a whole bunch of great stuff. Now, let's talk about this. Let's say you've got a stock at 200 bucks. Now, I want everybody to pay attention here, by the way. And I'm taking a survey. So I am going to want you to answer this question. Okay? I'm going to want you to answer this question. So get ready. There's a stock at $200 a share. Which of these two trades is riskier? Oh my goodness. Excuse me. Which of these two trades is riskier? Buying a 14-day 200 strike call at $5.60 or buying a 14-day 220 call at 32 cents? Which one is riskier? Justin is not afraid. Justin is not a chicken. Like some of you might be chickens because I don't see your answers. I said everybody has to answer this question. Either you're not paying attention or you're a chicken or you're just a little shy. And we can't have shyness in trading. Like you got to be bold, right? We're option traders here. We're bold, right? Justin says 1. Mike says 2. I think there might have to be a cage match between Justin and Mike. What do you say? Who do you think would win? Justin, you think you could beat Mike in a cage match? Mike, what do you say? Think you can take Justin down, get him in a headlock, give him noogies? I don't know. Costas also says 2. Oh my gosh, what do you know? John, read that question a little bit more carefully, will you, my friend? Teresa's new to this. Okay, well, that's fair. That's fair. Not a chicken. She shows up. She typed it in. That's good. Okay, that is fair. New to this, you're off the hook. Jeff also says number 2. You guys are crazy. No, you're not crazy. This is what you might call a subjective question. Because here's the thing. The 14-day call, you can make a case, or well, they're both 14-day calls. The 200 strike call, you can make a case for that being riskier, right? You're risking more. It costs more to make that trade. It's $560 for a one-lot trade, right? If it goes down, it's got a bigger delta. If it goes down, you start losing money faster, right? But you can also make a case for the 220 calls because the 220 calls, they just have a little delta. And even though their theta, their time decay is smaller, which is another thing we can say for the risk, in Justin's camp, we can say about the risk of the 200 strike call. It's got a bigger theta. The 14-day call, that stock really has to, it's got to go. It's got to go up, and it's got to go up a lot in order to have any chance of making a profit. Now, don't get me wrong, it doesn't have to be in the money at expiration or anything, but the theta is going to eat away at any delta potential, pretty quick. It's smaller, but in some ways it's more relevant. If we are holding this to expiration, the stock would have to go up all the way to 220 just to break even. So, they both have their own unique risks. And I would go as far as saying neither is necessarily riskier than the other. They're just different in terms of risk. So managing risk in option trading always comes down to two strategies, or two stages, I guess I should say: constructing the trade and managing the trade. Because that's it. Those are the two things that you do with any trade: construct it and then put it on, and then manage it and take it off. That's it. Those are the only two things you have control of: constructing, managing. So let's talk about some opportunities here. We could say, our goal is to set up a trade with optimal risk reward versus the likelihood of success, which kind of takes us back to this a little bit, right? Which has better risk reward? Well, I don't know. I mean, maybe the 220 calls, right? If the stock goes up to 250, I mean, I'm only risking 32 cents and I can make $30, right? But its chance of success is a great deal smaller. A lot of people think in terms of risk reward, because like that's like a phrase in the vernacular of anybody who even thinks about option trading. Risk reward, or any sort of trading, or any sort of investing. Risk reward, risk reward. And you get hung up on that. Oh, the more risk I take, the more reward potential, which is generally speaking true, but that's pretty much, you can tweak that a little bit, but it's basically more risk means more potential reward. Less risk, probably less potential reward. But really, it's not this versus this, because it can't go like this, right? It can go like this. Very small changes. But so what it really is it's this versus likelihood of success. Those are the two things that were really, and like those also can't go too disparate either, right? There's a balance there as well. So what we always want to do with any trade is identify three choices and pick the best one. Now that sounds like the most boring advice anybody could ever give you. What do you mean? Pick three choices and pick the best one. How am I supposed to know what the best one is? Well, you know what? You kind of do if you're doing it right. If you're forecasting this out well and thinking about your risk on your option trades, you're just going to naturally do that. So let's take a trade here. Who has a stock that they're bullish on? John says, I use a spreadsheet for that, which, by the way, tell your wife spreadsheets rock. I will do that. I'm going to do that. She is the one who sends, because I use a spreadsheet for this stuff too. Helps me think it through, make sure I'm not missing any steps. All right. So local networks. Oh, this my internet connection's unstable. What the heck are you even talking about? Stocks. I'm gonna go EOSE, not order entry. Oh my goodness, I clicked the wrong darn thing. This is what I was looking for. That is not what I was looking for. This is what I was looking for. EOSE. What is this symbol? I wanted to look this up first because I wanted to make sure the option markets weren't oppressively wide, which surprisingly they're not. EOS. I'm not familiar with this stock. What is this stock? EOSE stock. I always just Google it. EOS Energy Enterprises. Okay. Got something to do with energy. Something to do with energy. Okay. So John here, John's bullish on this. Now, look, I mean, this is one of these cheapo stocks, which doesn't necessarily mean it's not a design manufacturer's battery storage solution. Okay. Well, what do you know? So, okay. That's what I wanted to see first. But what I need to see next is I need to see a chart. Not order entry. EOS. Real-time chart. Jay, when you click the wrong darn button. Holy moly. Hold on a second. Hold on a second. I see what you're doing here, man. This one. This man is a short squeeze candidate, isn't it? So all I do is I just go and I check the short interest, which is, yeah, it's 29.58% on the most recent data. And when you got 30% of the float being shorted, you can see some of these big moves that bing pop up. I don't know if this is earnings or not. It could have been earnings. I'd have to just double check that. So, okay. You're looking at us. There's pop on earnings. Okay. So, okay. So we're looking at this, right? And we're like, so was that earnings? What I always like to do is I like to go EOSE invest in, no, investor relations, events and presentations is going to be your friend for this. May 15th is the annual stockholders meeting. The conference call, oh, that just happened May 7th. So that was last Thursday morning. Okay. And so this here is, what do you know, May 7th. So yeah, there's the pop on earnings. So a lot of times, I mean, not always, I haven't, have I done a study on this? No, I haven't done a study, but a lot of times we get a follow through earnings. I don't know what percentage offhand. But John here is looking for this to continue higher. So here's what we have to do. We have to decide, how are we going to play this? Am I going to buy a call? If so, which call am I going to buy? I could buy, like, do these have weeklies? I forget. I think there was a bunch of expirations, right? They probably have weeklies. Let's take a look. Yeah, these have weeklies, right? So it's trading at 640. I could buy the 4-day to expiration calls, which of course would have a very high theta. John saying, what about a deep in the money call? I could do that, right? I could buy these 4-day, 4-strike calls. They're trading at 640. I could buy them at 244. 244 plus 4 is 644. That's only 4 cents over parity. That's barely any theta, negligible theta, doesn't matter. But I would need the move to happen in 4 days. Because it's only 4 cents of time value, it's basically about 100 delta. It only has to go up 4 cents to break even. It's a very directional trade. But, the market is pretty, the market, hold on a second here. The market is pretty all over the place these days. And so, I don't know. Is 4 days really enough time? I think I would probably need more time. I would probably need at least the May 23rd, right? Now, the 4-strike calls, they have 7 cents of time value, which is still basically nothing. The 650 calls, they're 41 cents versus what were they? Here, what were they on these? Hold on a second. Oh, I can see both at the same time. That's right. 24 cents versus 41. I mean, honestly, I'd probably rather pay 41 cents on these. Now, you go a little further out, and the markets do get a little bit wider in some of these strikes. This is a pretty wide strike right here. Or maybe I need more time. Maybe I need the May 30 expiration. Actually, that's only 45 cents versus 41 cents for the May 23rd. Holy cow. I mean, if you're deciding between those two, pay 45 cents or 41 cents, I get a whole extra week for just 4 cents. I mean, that's a no-brainer. So, like, this is an example of what I'm talking about when I say look at 3 different ways to trade it and pick the best one. Because people always say, well, how do I know which is the best one, Dan? That's where I really need your help. I'm looking at the choice between these two, and you don't have to have a lot of experience with option trading to say, I get a whole extra week for just 4 cents. Yeah, I'm in. Now, if this is like a longer term thing, like a longer term investment, which sounds like that's what John is really thinking about here, well, then we need a lot more time for it to play out. Maybe we're talking like August. Now, there's no 650 strike there now, is there? So I could buy the 6 strike, which is already in the money by 40 cents. I could buy that for about $1.30. So I'm paying about 90 cents of time value premium over parity for that. If I go way in the money to get a big delta and smaller theta, I'm only paying 24 cents over theta. Or I can, in some ways, be more conservative, maybe buy the 10 strike for like 28, 29, 30 cents. I'd risk so much less, but I mean, hey, well, I'd risk so much less, but it would need to I would really need to, I mean, if I'm going to hold it for that long, I'd really want it to go above 10. It doesn't always have to make money, but if I'm holding it for a long time and suffering all that time decay, it's kind of got to go above 10. So my chances of that working are so much less. But if I'm comparing 30 cents versus $1.33 versus 264, it's more, it's a little bit more like a lottery ticket. I mean, it's not like a lotto ticket where your chances of winning are 1 in 600 million or whatever. I think your chances are definitely better than 1 in 600 million. But I mean, it's a little bit more like that. Remember, risk reward versus probability of success. My probability of success is a lot worse with that 10 strike, but my risk reward is massively better. I'm risking so much less on a one contract to one contract to one contract basis. Right? So, I mean, we want to, let's get this out the way here. And I gotta make sure I've got that one on my short squeeze list. You guys know I do short squeezes, right? EOSE short squeeze. Let's go wheeze. So, notice that there's a big difference between holding until expiration and before expiration. In online seminars like this, you always see some guy like me showing these hockey stick diagrams, right? Profit and loss diagrams. Well, these are specifically the profit or loss if you hold it all the way until expiration, which I'm going to have to see that. I'm going to have to, if I was doing the way far out of the money one, 10 strike or 7.5 strike or whatever it is, I'm going to have to hold it until pretty close to expiration. But I want to get out before expiration. So what I'm really looking at is something more like this. Now, I had to draw that with my mouse pad. It's a little bit more jaggedy than I'd like to see, but it's the best I could do. I'm not an artist. All right. Not a graphic artist anyway. So as time passes, like that dotted line morphs into the hockey stick. And the difference between those is what is called theta and vega. It's called time premium, really, which are affected by theta and vega. The more in the money, the more I really care about that dotted line. I'm going to hold it for, like an at the money, I want to hold as short as possible because it has the highest theta. Without the money, I can hold for a lot longer, and I'm going to think more about the curved line there. I also, though, hold on a second. You know what I didn't think about? I mean, I actually did think about it, but I didn't talk about it. What if I'm looking for this longer term horizon? And let's see that chart again here. Oops. Okay. I guess I got to close this. So this is, if I, oops, I'm going to squish these together a little bit more. So, boy, oh boy, this is like, apparently, I don't know if is it all time high? Well, maybe not all time high. Maybe all time high. Here, I just click 10 years here and let me know. Not all time high. 5-year high, not 5-year high. 1-year high, not even 1-year high. So there is room to the upside. Did do, get some pretty good action there on earnings. Make this one day. Oops. And we got to pinch together a little bit more. Pinchy, pinchy, pinchy. So we have to decide what is a realistic expectation. Like this stuff that I'm talking about right now, it's very important. We need to decide what is a realistic target over a realistic time frame. It's too common for people to say, "Oh yeah, I'm bullish on that stock." Okay, well what does that really mean? Does that mean you think it's going from 640 here or whatever to 650 by tomorrow? Or does this mean you think it's going from 640 to 50 by next year? And your mind does kind of work that way. Oh, check the expected move. Yeah, something like, well, there's a couple different ways of doing that, isn't there? We look at the average to range. We could look at volatility, although the volatility always gives us a wrong information for that, which is good because that enables us to make money by trading, volatility, buy it when it's underpriced, sell it when it's overpriced. But yeah, I like the way you're thinking. Like we've got to have something to anchor our thought on, right? So let's say by August, for whatever reason, I don't know, like I don't even know this stock. I'm just going through John's example, but it doesn't matter. Oh, look at the straddle. Yeah, that's based on implied volatility, which I know exactly where you're coming from, but I take it a step farther than most people do and know that straddles are always misvalued. They're usually valued too high, which means that the range would be stated as too big of a range. But that's for another class. I love how you're thinking, man. I love how you're thinking. Sounds like you've been doing this for a while, which is great. Keep at it. So we've got to have something to anchor our expectations on. Let's say for whatever reason, I think it's going to $10 by August expiration. So therefore, I would not be buying those 10 strike calls in August. That would mean I'd be like certain to lose, right? So instead, what I want to do is start with the time frame and say, well, what if I bought these 6 strike calls and sold the 10 strike calls? If I don't think it's going above 10, that's exactly what I would want to do. Why? Because I care about probability of success versus risk reward. So if buying the 6 strike calls cost me $1.31, it costs me more if I go further in the money. If I do buy the 6 strike calls and I sell the 10 strike calls, let's just say I can buy these at $1.30 and sell these at 30 just for easy math. I'm saving 30 cents. I'm saving like 25% of the value of the trade. So I'm risking 25% less. My reward goes up if it only goes to 10, right? Because my break even Well, here, look. My break even at expiration with the long call, if I pay $1.30, is the 6 strike plus $1.30. This would be $7.30. But oh, imagine this is a call debits. Well, here, I got a call debit spread. If I buy the 6 strike calls and I sell the 10 strike calls and I only pay a net of $1, well, now my break even is 7, not 7.30. It's 7. But I get a trade-off for that. I give up opportunity above the short strike. But if I only think it's going at about to 10, what do I care? I make a bigger profit percentage-wise and in real money-wise. I make an extra 30 cents if I do the spread instead. Okay, but what if I want to be even more conservative than that? Well, what I could do is I could sell a put credit spread. Hold on now a second. Hold on a second. Wait. What if I sell the 6 strike puts at, say, 87 cents and buy the 5.5 strike puts at 67 cents? Bring in 20 cents, which would be the most I could make. What's the most I can lose? 30 cents. Boy, if you're bullish on this, I mean, that's a pretty nice trade right there. You always risk more than you can make when it comes to credit spreads, but it doesn't even have to go up to make money on this. You're risking 30 to make 20, and the odds are very much in your favor. It has to go down about 8% in order for it to be a losing trade. Or I could be even more conservative. I could sell the 550 puts and buy the 450 puts. Figure I sell these at 62, buy these at 32. I collect 30 cents, and then it would have to go all the way down to 550 to lose money. Huh. Okay, hold on a second here. Oops. What does that look like on the chart? What I say? Oh yeah, I can get 30 cents, right? You have to go down to 550. So that was before their earnings, their most recent earnings were made known. It's pretty, and it's a support level there. So it would have to go down to where it was before the information of how well they did last quarter, which apparently was beat expectations. The market took it as pretty positive news. That could be a better way to trade it. I could be even more conservative and go to 5, which would be a very strong support level. Let's see. You think I could make that work? Let's take a look. Let's take a look. Options. And I'm just kind of going through, like, this is my thought process on every single trade. I'm giving you more than 5 ways or more than 3 ways to trade it. But what if I sold these at, say, the 5 strike puts at, say, 45 and bought these at, say, 20? So I collect 25 cents, risking 75 cents to make 25 cents. So basically, 25 cents is a third of 75 cents. So I'm risking 3 to make 1. Do I think my chance of success is greater than 25% of it staying above 5 by August expiration? And I don't know the answer to that question. It doesn't matter. I'm not giving a trade idea at all. I'm just saying this is how you think about it. This is a smart risk tactic. This is a way to measure your risk on a few different trades and take the one that makes the most sense in the scenario, which I think we kind of did here. Now, we don't have a, million hours of time left here or anything, but does anybody want to throw, maybe somebody besides John, you want to throw out a, hold on a second, I got to share my screen again. You want to throw out another trade idea here? I am sharing my screen. What am I doing? There we go. Anybody want to throw out another trade idea here? Thanks, John. That was actually a really great one to go through our example. Or, we could, oh, wait, now I'm not sharing my screen? Come on now. All right. How about something China trade war? Yeah, that's a good idea. Gosh, well, that could be anything, right? I mean, we could, give me you got a specific idea? And I say it could be anything. I mean, it can't be anything, but it could be a lot of things. It could be anything that, oh, I got a great one. What about Honeywell? In Honeywell, a lot of their products have hundreds of parts. They make a million different, not a million, but it's a lot. Tons of different products. Everything from like parts of a eVTOL, flying car to, something that might go in a calculator to, a motor for a stand-up desk. So many different things. So let's look at that, right? This would be a good one. Oops. I keep putting my cursor in a weird spot. So HON, let's take a look at Honey Pie here, huh? Yeah, so they've been having a bit of a time since these tariffs have been announced, huh? This is the April 3rd, which is a very important day. Who knows what April 3rd? Who can tell me what April 3rd is? This guy's birthday. That's right. This guy's birthday. So you don't want to forget that. I can give you an address to send presents. Hold on. Just got to bring the Q&A up. Oh, thanks, Lisa. Um, you're a little late, so you might want to send like an extra birthday present. I'm just saying. Oh, so Costas has an interesting idea here. What about selling iron condors on this Honeywell? Well, let's take a look. Let's take a look, shall we? So on April 3rd is when the tariffs went into effect. Remember, because like they got announced on April 2nd after the market closed. So bam, 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 bam. Because Honeywell relies on China for so many different parts. But up, 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 up. It kind of started going higher, and this is probably their earnings. I know they had their earnings right around this time, so big jump in earnings, kind of followed through. Interestingly, for those of you who are watching this live, today, what is today? Monday, May 12th, 2025. Trump announced, just kidding again, about the tariffs. I'm a practical joker. we're going to pause the tariffs with China for 90 days. Well, it wasn't quite that dramatic. They had a discussion and they agreed to pause it for 90 days. So the market in general, last time I looked, was up pretty good. Still is, as you can see here. Pulled back just a smidgy. Just a smidgy poo. But Honeywell actually didn't really take off that much, which is kind of interesting, isn't it? Because Honeywell is one that's really affected by China. Maybe there's overzealousness in the broad market. I don't know. I don't know. Whatever reason, sometimes there's just not logic to these things. Sometimes there is. And this is not intended to be a fundamental discussion about Honeywell by any stretch of the imagination. But one thing I do know, well, a couple things I do know. Got a gap here where it didn't trade at any of these prices here or the last time. They say when there's a gap, it's intended to be filled, which would be a downward move if that were to happen. But here we have very strong support. Bounced here, 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 bounced here in a different way. Just kind of went right through it. I said support. I meant to say resistance. Strong resistance. But there's also a gap here too, isn't there? Not quite yet filled. So boy, oh boy, Honeywell could move around a lot. Or we could look at this as a bit of an anomaly. And now, hey, our heads are on straighter. Maybe there'll be less movement, which could give credence to Costas's idea of a iron condor. I would have to do a lot more thinking about it before I commit to either of those things. But just for argument's sake, and we'd want to see how much the straddle is and how much the iron condor would be. Just for argument's sake, very hypothetical. Let's just say, hey, you know what? I'm on the same page as Costas. I think we're going to stay between 220, which would enable us to fill this gap, and 205, which would almost enable us to fill this gap. But we do have a pretty established zone here, minus, the tariff panic sort of scenario. So this is very hypothetical. I don't have a horse in this race. I don't necessarily believe in this trade or disbelieve in this trade. Just saying, if you think this, let's think about how to trade it, between 220 and 205 over the next, say, month. All right, cool, man. Let's check it out. What do I do first? Well, go to options. Darn it, went the wrong place. Go to options. Go to Honey Baby. Get the option chain. And I want to look a month out. Today is May 12th. So I probably want to look about June 13th. Can I sell the 220 calls for a good price? Gosh, yeah, sure can. It's probably a pretty high implied volatility here. Can I sell the 205 puts for a pretty good price? Yeah, sure can. Now, I'm always thinking about risk reward, right? This presentation is called Smart Risk Tactics for Option Traders. What's one way I can eliminate my risk? Well, I mean, one, I could go wider strikes, but I could also go less time. Honeywell can move less in a shorter period of time. What if it was 2 weeks? Well, I can still sell the 205 strike for a pretty good amount. Still sell the 220 calls for a pretty good amount. Or what if I keep the month? Because, there's a case to be made too. Like, if you look at what the person before was talking about, looking at the price of the straddle, if you've ever seen, you can see like um, what do they call those? Parabola, like sideways parabola of likelihood, if you've ever seen one of those. And once you go far enough in time, like it's not more likely, a move is not more like much more likely to happen over 11 months than it is 12 months. But 2 weeks versus 1 month, yeah, maybe, maybe it is. So anyway, the moral of the story is if my real time horizon is a month, instead of selling the 205 puts, I might want to sell the 200 puts. Now, look, the markets are pretty wide here. So, I know because this is about smart risk tactics, right? If I were to put it on at a decent enough price, like obviously I'm not selling that at a dime. But if I could sell it at like, 2.25 or something and buy this for like, two, that's still not a lot, right? I'd probably have to let this expire. So I lose a lot of liquidity here, which I'm not thrilled with when I start getting too far out of the money. Same here. It's not so bad to the call side. I could put on just the call side, wait for the market to go down, and then put on the put side and hope it gains some liquidity. But I never want to hope, right? Hope is not a strategy, as they say. I was telling a one-on-one coaching student that it's like, no, you can't have hope. And she's like, I can't have hope. Oh, this is terrible. What do you mean I can't have hope? I have no hope. That's not what I'm saying. I'm saying you should not rely on hope. That is not a strategy. You should have a strategy. And, you can hope your strategy works out, sure, but, you're not relying on that. You're knowing full well that it's statistical. So, when you do put on one side of an iron condor now and the other one later, it doesn't always work out. Sometimes you never get that second leg. So I could go take a look at what's in the June 6th. Well, one thing, here's another thing. The June 20th, this is a monthly expiration and they're a lot more liquid. So if I add another week, I gain a ton of liquidity. I could go $10 wider. Sell these at 70, buy these probably about 50, so that's 20 cents. I'd kind of like to get more on a $5 wide spread. Or I could sell the $200, the $200 one at say $1.10, buy these at 80. It's 30 cents. I'd probably have to do a little better on that. I don't know, but look, hey, now there's a great question too. What is the IV percentile or the IV rank? Well, yeah, those are good questions too. Especially if here's where that question really becomes relevant is if I'm going to Greeks and analytical and I'm looking at what the implied volatility is of each of the strikes that I'm talking about. If I'm talking about selling the 200 puts, well, that's a 24 volatility. Then I see what the IV rank is or percentile is. And if I can sell this above, like in the top half of the last, I like to use 6 months. I know that stuff's based on 12 months. Personally, I like to use 6 months. If I'm selling this in the top half of the range of the 6 month implied volatility, that sounds kind of good. Right now, it's a weird market right now. Implied volatilities are actually a little bit low, even though the oscillation that's taking place is pretty big. So it's kind of weird. But anyway, just to kind of just to kind of finalize everything we were talking about here today, this, friends, this is how we do this. This is how we find the best way to trade something. Like, sure, if I'm bullish, I could trade it 100 different ways. But which is the best one? Here's what you don't want to do. You don't want to get in a situation where your forecast is right, but you lose money because you traded it in suboptimal way. That's the last thing you want to do. So I hope that this was thought-provoking so that when you see stuff like this, you can make optimal decisions. That is my hope for you. And that's all we have. So I hope that helps. This is Dan Passarelli. I will see you next week. We're back on our regular Tuesday schedule. Oh, I was just wondering. I was like, man, there's fewer people here than there usually is. Yeah, it's because we usually do this on Tuesdays. I goofed up our days. But next week is protecting stocks in down markets using options. And it's a good one. It's an important one. So I will see you next week. Trade smart. Catch you next time. Bye.